Good afternoon, everyone. Good afternoon, everyone. We're going to get started with our program. And this is, I promise you, the last time I'll be at the podium during this conference. And so before I introduce our speaker, I want to just say one more time how much of an honor and privilege it has been to serve as president of the Federal Reserve Bank of Cleveland, especially during this extraordinary period in our country's economic history. So thank you very much for that honor and the privilege. And then I also want to take this time, and this is very important. Oh, thank you, thank you. Oh, you guys, thank you. Thank you, thank you. Thank you. Thank you, Chris. Thank you. Thank you very much. Thank you. Thank you very, very, very much. I also wanted to take time today to congratulate the organizers of this conference. Mark Schweitzer, along with Todd Clark and Ed Notek from the research department, and Kelly Banks from our community relations department. I think they just did a phenomenal job in organizing this conference. So I want to thank all of them. Thank you. I really do mean that this conference was just a great way for me to spend my last day at the bank. And I am looking forward to being invited back to many more inflation conferences. So thank you so much. But now it's my honor to introduce my successor and our keynote speaker, Loretta Mester. I've known Loretta for more than a decade. We talk regularly in Washington, D.C., around the FOMC meetings. Loretta has attended those meetings for many years as the chief policy advisor to the presidents of the Federal Reserve Bank of Philadelphia. Loretta, on Sunday, will become the 11th president of the Federal Reserve Bank of Cleveland, and in less than 3 weeks, on June 17th, she'll be taking my seat at the FOMC meeting around that FOMC table. And on June 18th, the day that the vote is taken on policy decision, Loretta will cast her first vote as an FOMC member. Loretta, if you were writing a resume for the prototype Federal Reserve Bank president, you could not do any better than Loretta's CV. Loretta is a distinguished and widely respected economist and leader. She has vast experience and deep knowledge of the economy, of financial markets, and the Federal Reserve System. She joined the Federal Reserve Bank of Philadelphia in 1985 as an economist, and then she advanced through and held several positions at the bank. Her most current role was as Executive Vice President and Director of Research. In this role, she, as I mentioned, attended the FOMC meetings, but she also oversaw a staff of economists and analysts in the research department, and she also oversaw professionals in the financial statistics department and the payments card center. Loretta is actually the second Director of Research from the Philadelphia Fed to become a president of the Federal Reserve Bank of Cleveland. Lee Hoskins held that position also, and he was our 8th president. So that's 2 data points. One more and we'll have a trend. Loretta graduated summa cum laude with a Bachelor's of Arts degree in Mathematics and Economics from the Barnard College of Columbia University, and she earned a Master's of Arts degree and a PhD in economics from Princeton University, where she was a National Science Foundation Fellow. I said earlier that Loretta's background provides a prototype for a Federal Reserve Bank president, but I want to modify that statement just slightly. I expect Loretta to break the mold of what a Federal Reserve Bank president can accomplish, and I am very confident that Loretta will take this bank to greater heights, and I am extremely proud that she's going to be succeeding me as the next president of this bank. So please join me in welcoming Dr. Loretta Mester.
Well, thank you very much. I want to thank the ClevelandFed for inviting me to speak today, and I thank you, Sandy. That was an incredibly warm introduction, and I really appreciate it. Of course, I'm very honored to have been chosen as the next president and CEO of the Federal Reserve Bank of Cleveland. And, you know, I realize I have very, very, very hard act to follow, but I'm really grateful that you built such a fine institution. The conference we've enjoyed over the past 2 days underscores the strengths and also the interests of the ClevelandFed researchers. And I plan to build on that foundation when I take over my new job officially next week. So understanding inflation dynamics is of vital importance to central banks. And today I'm going to focus on open research questions surrounding inflation from a policymaking viewpoint. Now, I toyed with the idea of titling my talk, "We Need Your Help." But I decided that, you know, I thought better of that. And nonetheless, my hope is that I'm going to inspire the researchers to work on some of these open questions and perhaps participate in a future conference here at the ClevelandFed. So I view conferences like we've been enjoying over the past couple of days that bring together central bank, academic, and market economists, as well as members of the business community, as important avenues to improve our collective understanding of the economic issues facing monetary policymakers. And before I continue, I must note that my remarks are my own and not necessarily those of others in the Federal Reserve System. So Congress has directed the Federal Reserve to conduct monetary policy in pursuit of a dual mandate of maximum employment and price stability. And in my view, these goals are complements. In keeping with the theme of our conference, I'm going to concentrate today on the price stability part of the mandate. Now, the benefits of price stability for the economy seem clear, and they've been pointed out by a number of Fed officials over the years. When prices are stable, businesses and consumers can focus on productive activities rather than on ways to protect the purchasing power of their money. They can make long-term plans and commitments without having to deal with the uncertainty about the value of their money. Also, when the price level is stable, any price changes reflect changes in the supplies of certain goods and services relative to others. These relative price changes provide important information for businesses and consumers when deciding where to allocate their scarce resources. Now, another significant benefit of price stability is that it promotes the other important responsibilities of the central bank. It helps foster financial stability by minimizing unexpected transfers between lenders to borrowers that happen when inflation causes loan values to fall. And by fostering confidence in the economy, price stability supports growth and maximum employment, the other part of the Fed's dual mandate. So I think you'll agree that price stability is valuable, and it is an important goal of monetary policy. This is fitting since over the longer run, monetary policy is the principal determinant of inflation. And in fact, the Federal Open Market Committee, or FOMC, made this important point in its statement on longer run goals and monetary policy strategy, which it issued in January 2012 and has affirmed each year since. So this statement lays out the guiding principles that the FOMC follows in setting monetary policy. As part of those principles, the statement established for the first time an explicit numerical goal for inflation over the longer run. The goal is 2% inflation as measured by the year-over-year change in the price index for personal consumption expenditures, or PCE inflation. Being explicit about the inflation objectives reflects the FOMC's desire to be transparent and communicate clearly to the public. But it also underscores the FOMC's commitment to price stability. When businesses and consumers have confidence that the central bank is committed to 2% inflation over the longer run and will defend that target when inflation is either above or below it, they are more likely to look through temporary changes in inflation. This helps anchor inflation expectations at the target. As a result, underlying inflation will be less responsive to one-time supply shocks such as changes in the price of oil. So having an explicit target helps promote price stability. So I view the FOMC's statement on its long-run goals as entirely consistent with the Fed's dual mandate. The statement makes explicit that the FOMC will take a balanced approach to meeting its mandated goals, and it explains why the FOMC has established a numerical target for inflation, but not a comparable one for maximum employment. While monetary policy is the chief determinant of inflation over the longer run, the maximum level of employment is largely determined by demographics, production technology, and other factors that change over time and are not influenced by monetary policy. So while the FOMC can choose the value of inflation it seeks to achieve over the longer run, it does not have the ability to achieve just any long-run objective for employment. Long-run employment is determined by economic fundamentals. Now that said, sound monetary policy is a necessary ingredient in promoting strong economic fundamentals, allowing the economy to more effectively achieve its potential. So by helping policymakers set appropriate monetary policy, the explicit 2% inflation target promotes not only price stability, but also full employment over the longer run. Today, the FOMC reiterates that 2% inflation goal in the policy statement it releases after its meetings. And the target is an important part of its forward guidance on the policy interest rate. For example, in the April policy statement, the FOMC said that in deciding how long to maintain the current 0 to 0.25% target range for the funds rate, the FOMC will assess realized and expected progress towards its objectives of maximum employment and 2% inflation. That the FOMC is now more explicitly formulating its monetary policy in terms of projected progress towards its goals underscores how important it is for policymakers to be able to accurately measure inflation and inflation expectations and to forecast inflation over the medium and longer run. Now, as we've discussed over the past 2 days of the conference, there has been considerable progress in advancing our knowledge of inflation dynamics, measurement, and forecasting. But there is more work to do. So what I'd like to do now is discuss 6 open questions. So not quite as many as a David Letterman top 10 list, but questions where I believe further research is going to be essential for helping to inform our understanding of inflation and in turn in aiding monetary policy making. So I'm going to start with a couple of measurement issues. First, how should we estimate the underlying trend in inflation? So, of course, there are various measures of inflation. The FOMC's preferred measure of consumer inflation is the PCE inflation rate. A perhaps more familiar measure is the Consumer Price Index, or CPI inflation rate. Even though these and other measures of inflation tend to move together over the longer run, they can diverge in the short run. Policymakers need to look through noisy month-to-month changes in the indices to discern the underlying trend in inflation. They need a way to separate temporary changes from changes that are more persistent. To get a signal about the underlying trend, many economists look at the traditional core measures of PCE and CPI inflation, which excludes the food and energy components because they tend to be very volatile. But research has shown that the prices of other components of the CPI basket, like apparel, tend to be even more volatile than the prices of food. For that reason, the ClevelandFed's measures of median CPI inflation and 16% trim mean CPI inflation are potentially more informative than the core CPI measure. In constructing their measures, ClevelandFed economists exclude a percentage of the most volatile components each month, regardless of which items they happen to be. These measures have been shown to help identify the underlying trend in CPI inflation. On the other hand, some of my own research has shown that headline PCE inflation can beat the core measure in predicting future PCE inflation. And a further forecasting complication is that PCE inflation gets revised over time. This leads me to my second research question. How should monetary policymakers incorporate revisions to PCE inflation into their policymaking framework? Policymakers need to set monetary policy in real time, knowing that their policy affects the economy with a lag, and knowing that their targeted inflation measure is subject to revision. The revisions are beneficial because they reflect new data that yield a more accurate measure of inflation. But the revisions also pose a challenge to setting monetary policy. For example, in early 2002, policymakers were concerned about a drop in inflation. However, this drop was ultimately revised away. Now, of course, policymakers know that the data are going to be revised. In fact, some interesting research has shown that the revisions can be predicted to a certain extent. But understanding the magnitude and pattern of these revisions could help inform policymakers about how best to respond to changes in measured inflation rates. More broadly, further research on how monetary policymakers should set policy in the face of uncertainty about the state of the economy would be useful. Now, my next questions concern the nexus between our economic models and our measures of inflation. Question 3 asks, would households and businesses be better off if the central bank chose to target an inflation measure other than headline inflation? Some theoretical models suggest this is the case, although there is still quite a lot of debate in the literature. According to some models, central banks should target those prices of goods and services that tend to respond slowly to changes in economic conditions, what economists call sticky prices. So to see some of the practical implications of this question, suppose the model's right, and it is best to stabilize sticky prices. One admittedly crude way to identify sticky versus flexible prices is to break up the overall consumer price index into its services and goods components. Today, if you look at core prices in the service sector, inflation has been relatively stable at 2.25% to 2.5% since 2012. It's the less sticky core goods prices that have decelerated and have brought the broader measures of inflation down below the FOMC's goal. Even a less crude measure of flexible versus sticky price inflation, which was developed at the ClevelandFed and is now provided by the Federal Reserve Bank of Atlanta, shows that sticky price inflation has been relatively stable around 2%. To the extent that the model is valid, this paints a more benign view of recent inflation, one that could have implications for the appropriate path of monetary policy. Now, of course, these models are simplifications based on several assumptions, and they're not ready to be used for setting monetary policy. However, I think the example provides ample motivation for further research on alternative measures of inflation and modeling. That our models could benefit from further research underscores my fourth research question. How should we reconcile the actual pricing behavior of firms with predictions from the workhorse inflation model used by many mainstream macroeconomists, the so-called New Keynesian model? The availability of data on the individual prices used to construct aggregate price indices like the CPI has allowed some intrepid researchers to establish several interesting facts about real-world pricing behavior. One finding is that firms appear to change prices more frequently than predicted by standard macro models that have been calibrated to match various features of the macroeconomic business cycle. This is a troubling finding in that it suggests a disconnect between the micro data and macro models that are often used to inform monetary policy analysis. Better reconciliation of the models with the empirical facts of the micro data would be a welcome avenue of additional research, and I would expect our models to improve the more we learn. In fact, models of inflation have evolved over time as economists have become more knowledgeable about inflation dynamics. Modern theories have emphasized the important role of inflation expectations in determining current and future inflation. This brings me to my fifth research question. Which measure provides the best gauge of inflation expectations? So surveys provide one way to measure inflation expectations. The Michigan survey asks households about their expectations. The Blue Chip Consensus Forecast polls economists, and the Philadelphia Fed survey of professional forecasters does exactly what its name suggests. But surveys don't solve the measurement problem because measures differ across the surveys. So economists have derived other measures of inflation expectations from financial market data, including the spread between nominal Treasury bond yields and yields on TIPS, or Treasury inflation-protected securities, and rates on inflation swaps. But isolating inflation expectations from these measures is not a trivial challenge. Now, to help address the measurement issue, the Cleveland Fed produces estimates of inflation expectations that combine information from a number of different sources. The methodology is based on a model of long-term interest rates, which reflect expectations about what short-term interest rates will be in the future, as well as the premia investors demand to compensate for expected inflation and for the volatility in inflation and in short-term interest rates over time. Cleveland Fed researchers use data on nominal yields, inflation swaps, and surveys of inflation expectations to separately identify these factors, which allows for a better measure of inflation expectations. In addition to improved measures, clearer understanding of how inflation expectations are formulated and the interplay between expectations and actual inflation would be quite useful to monetary policymakers. While theory suggests that changes in inflation expectations should lead changes in inflation, in some studies the empirics go the other way. Moreover, there have been times when inflation expectations seem to have become disconnected from actual inflation. For example, in Japan, after a long period of being stuck near zero, actual inflation ran below zero from 2009 through mid-2013. Even so, measures of inflation expectations were near 2%, well above actual inflation for a number of years. This presents a conundrum. Either the measures of expectations are off, or our theories of inflation and inflation expectations are off, or both. Whichever it is, there's implications for inflation forecasts that put a significant weight on inflation expectations. This brings me to my sixth and final research question. Is there a way for central banks to communicate about inflation and inflation expectations that will help ensure inflation expectations remain well anchored and increase the central bank's credibility for achieving its inflation target? Answering this question hinges on better knowledge of the relationship between inflation and inflation expectations, more accurate models of inflation dynamics that match the data, and measures that lead to more accurate forecasts of the underlying inflation rate. All of the research questions I've just discussed. I believe effective central bank communication is a crucial area for further research, especially in today's environment when monetary policymakers are relying on forward guidance on interest rates as a primary policy tool. So in my remarks today, I focused on the price stability part of the dual mandate in keeping with the theme of the conference. We cannot have full employment over the longer run without price stability over the longer run. And that's why understanding inflation is so important for Federal Reserve policymakers who aim to set policy to achieve both parts of their dual mandate. Now, of course, I know I've laid out quite an ambitious research agenda here, but good policymaking depends on the research that informs it. And I urge the researchers at central banks and academia and in the private sector to tackle these questions and to do so sooner rather than later. And I hope that we can reconvene this group at a future Cleveland Fed conference and that you can discuss your advances at that conference. The more we understand inflation dynamics, the more we're going to understand how inflation will respond to changes in monetary policy. These findings are going to be particularly relevant as the Fed, in response to improvements in economic conditions, returns to a more normal policy-setting framework over time. Thank you very much for listening. Thank you. Thank you. So, before I turn the podium over to Mark, who's going to conclude the conference with some closing remarks. I do want to say that it's been a great pleasure being here over the last 2 days. I've run into people that I've known for a long time, but I've also met a lot of new people, and people in the Cleveland Fed and people in the district, and everyone has been so welcoming to me, and I just really appreciate that. And again, I thank Sandy for her remarks, and it's been great. And I too want to, someone once said it takes a village. And when she said that, she wasn't talking about putting on a conference, but it really does take a village to put on a conference. And I too want to thank everyone at the Cleveland Fed for the work that they've done to put this together. I know I've learned a lot being here the last 2 days, and I hope you did too. And part of the great thing about the conference was the conversation that the audience had, right, in response to some of the presentations and that give and take. And I really appreciate that, and I learned a lot. So thanks again for being here. Thanks again for listening, and I really appreciate it. And Mark, why don't you come up?
Well, I'm going to be very brief. For those of you who were here yesterday, I'm not going to try to summarize the entire day. That is well beyond my ability at this point. I do want to thank everyone for their participation, and I want to acknowledge that this was a little bit of an experiment. So now that we're done with the experiment, we can acknowledge that. What we wanted was a conference that had a really good research component, a really strong and active and forceful dialogue between researchers. We certainly had that. We also wanted a more public-focused round of communications that would involve a broader community. I was very pleased to see that, many academics chose to stay for the second day. I was also very, very pleased to see many business people and other people come and join the conversation on day one. Because inflation is really not our problem. It's a critical issue for the entire economy, our country, to work with. So with that, I really appreciate all of your efforts, and I'm really grateful to hear the endorsement of the continuation of this conference. So I do look forward to seeing you here again. And I would like to say one last thing, because my current boss, Sandy Pianalto, has been extremely complimentary of the research department and acknowledged the fact that we do help her. And I'm really glad to hear that's the case. And I've appreciated those many kind remarks, but I want to be very clear and direct about saying that without Sandy Pianalto's leadership, we don't have the research department that we have today. So I'd like to end with acknowledging, because this really will be my last chance, to acknowledge Sandy Pianalto and her service to this bank as the 10th Federal Reserve Bank president.